Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Hey guys, I'm a little bit late, but we've got GDP coming up here in about 2 minutes. You can look at the liquidity out there in the treasuries. They're already pulling. We're only putting up like, a few hundred contracts per price. And you can go and look at the options and so forth. The market is expecting big things for GDP. So let's just go really quickly over to the chart over here. If I can find it. Which one is it? Where is it? This one. Okay, so here's the ZN. We had a really good day yesterday. Okay, they had a really good day yesterday. And we're off the highs, but they've continued up in the overnight session. S&P 500 has started to rally overnight for who knows why. Oil looking good. Silver and gold had like a really good day yesterday, and copper's looking not too bad either. So lots of gaps and so forth because there is some rollovers, but anyways. So yeah, we got about 20 seconds here. I am not going to trade this initial number because I'm expecting this to be a wild one, right? So let's just see what happens. Oh man, look at that liquidity. Okay, so we got a higher than forecast 5.2%. But that was just the headline number. We're still waiting for like the price index, deflator, PCE prices, etc. Okay, a few robots turned back on, but okay, core PCE was 2.3, lower than forecasted 2.4. GDP price index 3.6 versus 3.5. So this is a little odd. I don't know. The numbers, I would say, a little bit more bullish than expected. I would expect that to be slightly hawkish, but the market doesn't seem to be reacting to it too strong. Abdel Aziz, that is where is that an Arabic name? It's kind of a cool name, to be honest, but welcome to the stream. Good morning. Good morning to everybody else. Chewy, Dom, Octavius, Alan. You guys are here every day. You've been so good, and you say good morning like right at the beginning. I really like that. I really like, you're here before the stream starts and you say hi, and oh, it is okay. Now how you would say the last name Laul. I have no clue how you would say that. I gotta tell you, man, I find, well, all foreign cultures are just so interesting to me, but I find Arabic cultures particularly interesting. And the thing that kind of attracts me or makes me more interested in the culture is if it has like strong cultural values and ideas and stuff. And that's definitely the case with Arabic, right? So, you're from Algeria. That's interesting. I'm trying to think. I think we have had some people from Algeria before. I always find it really interesting when we get people from. Your English is not very good. Mm-hmm. I always find it real. It's really interesting when we get people from, non-European countries, let's say, because some of them have, rules that make futures trading really difficult, and they're all different. So I don't know. I don't know what the rules are in Algeria. Sometimes, from where you live, and the circumstances of your country, futures trading isn't really very for you, but it's still fun to come in and watch, right? So, are you gonna do a eulogy for Charlie? Oh my god. They better do like a minute of silence after the open of the S&P 500 or something like that, right? I was so devastated. So, just I'm sure that all you guys listening know what I'm talking about, but Charlie Munger, one of the co-founders or whatever of, why am I having a hard time even remembering names? I'm apparently I'm not fully awake. Oh, look at they turned back down. Okay. Well, the liquidity is still really light, so I think it's better for me to stay out. Berkshire Hathaway. Yeah. No, gosh dang it, the Uzi beat me to it. It's so funny that I would have a hard time remembering the name because I owned the stock. Anyways, Charlie Munger of Berkshire Hathaway passed away yesterday. They said that he passed away peacefully in a California area hospital. Oh, okay. It is a very sad thing. Who are we gonna get to, drop bombs and tell people how crappy cryptocurrencies are and things like that? Like, we need Charlie. I feel like we need Charlie. And we don't really have a good replacement for him. So I liked him. He was probably my favorite, market personality, I think. Oh, he will be missed. I was watching his best of, not his best. I mean, it was a best of video on YouTube or something like that. One of the things that stood out to me was he was always saying, we don't have a strict quantitative formulaic approach. Like if you want to memorize formulas in a process that doesn't work, go to graduate school. But that he always emphasized that there was a very qualitative, discretionary component to what they did, even though there was a very intentional strategy to it. And that matches up very well with my own intuition of markets, which is that because markets are very statistically efficient and very competitive, you can't just come in with a set of simple rules and dominate the market, because if it was that simple, then everybody would do it. So you kind of have to use something more sophisticated than that. And the thing that we as humans can do that's really sophisticated is use our intuition. Which means, that doesn't mean don't learn things. That's kind of one of the weird things, I think, is when people think intuition, that just means, okay, just sit there and do what you feel like. No. Absorb as much information as you can, and then the neural networks of your brains will figure it out, and you'll know the answer. It won't be like, oh, I kind of feel like, no, but you'll know the answer, but you just won't know how you know. So it's like the network is coming out with the answer and you don't know how it arrived at that. That's intuition. It's interesting. We all feel a great loss for a man who died at 99. Yeah, it really is. Well, I'm concerned that it's kind of like an old married couple, you know, like once one of them dies, the other one is soon to follow. We need Warren too. Oh man, I just keep thinking of that video. The other one that he was talking about was like stock buybacks. It's like generally stock buybacks are good. So some people do it just to pop up the price of their stock, and that's bad. But then otherwise it's good. And I'm kind of like, no. Like you just gave the whole thing away. Like it is bad. Because that's what they mostly use it for, is prop up stock prices. Oh, everybody did. Like here's the unique thing about Charlie. Like, think about this for a second. Yeah, has there ever been another billionaire that was more universally liked at his death than Charlie Munger? Because I tell you what, Elon Musk, okay, he's got a lot of life in him still. Okay, he's like what, 50, something like that. Okay, he's gonna be around for a long time. You know, we could have another 50 years worth of Elon Musk tweeting crazy things and making headlines and yada, 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 right? Okay. But when he goes, after the 50 years of more Elon Musk, there's going to be a lot of people that really don't like Elon. But Charlie is almost universally liked. Among at least among everybody that knew who he was. I would say that the average person doesn't know who Charlie Munger is. Only people in finance would know who he is. But I can't think of a billionaire more universally liked. But I think it was in part because he understood something that so many other people get wrong. And he stayed in his lane. Okay, like, wow, I don't know why I was thinking about this yesterday, but like climate change, okay? To be honest with you guys, I just don't care about climate change. And that's not to say that like I don't think it's happening, and I don't care if civilization ends or any of that. What I'm saying is I'm not a meteorologist. I really cannot do a very good job at getting into an argument about whether climate change is real or whether it's man-made or not. I can on the policy side because policy and finance, that's kind of my wheelhouse, right? So I avoid talking about climate change just because that's outside of my lane, right? And Charlie, all he cared about was investing, and that was all he talked about. And he didn't turn around and try and impose some bizarre philosophy or worldview on the rest of the world that was controversial. So that was like the wild thing about it, because Charlie was always saying off-color, controversial things, but people still loved him. Isn't that interesting? Maybe I'm wrong. Maybe there's some people out there in the cryptocurrency world that just absolutely despise him. But I don't know where they are today, at least. Let's say that. Okay, well, so we had a little bit of a jump in the treasuries after that news, which then promptly fell back down. And so that's a little off, I guess you could say. Like, first of all, I don't think that we moved as much as we typically would, so like last time we got GDP numbers, the market moved a lot more than this. And the thing is that, I mean, it is moving, but like it went up and it went down, and they haven't really resolved, or, you know, I don't think that they've really singled in on a single direction and set of assets and stuff like that. I am noting that you're seeing pretty heavy selling in ZB. So a little bit of steepening again. They're selling in ZB. They're selling not as much in the 10-year, but they are selling in the 10-year. They are not selling in the 5-year. So it's not across the board. So a spread trade going on here, but it may be starting to tilt to the downside to the point where, you know, we start to get enough of like a real trend. The problem in this instance is that I think by the time that happens, it's probably too late. That's one thing I'm always got in my mind is like, you know, if I've got a big question in my mind about what the market's going to do, we're in a range. Is it going to move up or is it going to move down? And by the time that I'm sure that the trend for the day is up, it's probably too late, right? That's why I want to make a prediction. I want to know that it's going to go up before it does that. And how do you do that? You've got to have information that tells you which direction it's going to go. And I'm not sure that we have that right now. I guess the things that we had going on yesterday. Actually, by the way, do we have... I need to look ahead. So that's one of the mistakes that I've made. Okay, that's right. Okay, so I don't believe that we have any auctions today. We do have a bunch of Fed speakers, but those are slated for much later in the day. We've got Mester speaking. We have also got the Bank of England Governor Bailey speaking. Now, with the Fed speakers, especially Mester, I wouldn't be surprised if Mester pushes back on the rally that we had yesterday. So recall that yesterday when Harker, was it, said that, hey, we could reduce interest rates if things continue to be like this, then we got the huge rally. Okay. I don't think that he intended to create a rally. Almost never the case that they intend to create a rally with the markets, unless it's Jerome Powell and he really comes out and throws bombs, right? But so I think that Mester might come out and try and temper the markets a little bit. So that is a flow that I'm going to say is uncertain to down as opposed to up yesterday. CTAs are probably still covering, but we did have a decent amount of upside action last night. And then we have GDP, which appears to be to the downside. Unclear. So we're kind of at a point where at this moment, we don't have a clear enough imbalance in the expected flows that we think that it's going to go clearly up or down. Now, if the treasuries were to come back up to the higher end of this range, they might say, oh, GDP was actually a positive for treasuries, and then maybe we could rally. I don't think that would be the case, though. I do think that higher than expected GDP should be a drag on treasuries, right? Like the deflator was in line, price index was slightly higher than expected, GDP was slightly higher than expected. PCE prices was just slightly underneath. So it's a little bit mixed, but I think that what they're doing right now is correct, that it should be slightly down. So if that's slightly down and everything else, and then we got CTAs are up and Federal Reserve comments are maybe down, but those are much later. We don't have an auction today. We do have oil, I suppose. That could be an interesting one because all that stuff going on without OPEC right now. Yeah, so that means I don't really have a trade right now. Roll over your strip. What do you mean? I do not know what that means. If Octavius is calling me a doofus, I really must be doing something stupid right now. Because he's not a mean one. H24 is so one of my instruments are supposed to be on March. Oh, no, we're still on December. Now I'm really confused. The front month is still December. Am I wrong? Maybe you're right. Oh, wait. 1, 2, 3. Oh, you're right. I am doing something super stupid. Yeah. Okay. Wow. Why? I have never been that off on, what's going on for the rollover. Jeez. Oh, by the way, why am I? Oh, that's weird. The icon for Discord is like larger than the other icons and changes the size of that. That's funny. But yeah, am I? Oh, I am rolled over on the other ones. Yeah, I don't know why I didn't even think about that. That's kind of funny. ZVH24. Let's do it. That would explain why the liquidity is still a little bit like, what the heck? NH24. You see, I told you, if Octavius was saying it, then I probably am being a doofus. Oh, man. Okay, that's a little bit more reasonable, isn't it? Yeah. Okay. Now we gotta do it for these ones, CBH. Well, so now we kind of got to consider that, don't we? Let's see here. Okay, so first of all of these are good until Friday. Okay. Although the micros will be probably a little iffy tomorrow. H. MES is not until the third Friday, right? CB, ZN, ZF, CBH, CNH, CFH. Okay, I think I'm updated. It did prompt me yesterday evening, and I changed it, and I was like, oh, how come I didn't catch that? Now I'm realizing why. So that's funny. Okay. And we are getting maybe a slight little reprieve here too, by the way. So, rollover. What do we think we should be expecting for rollover? Well, most of those basis traders are going to deliver, right? So, do you wait until delivery and then you start selling it again? I'm not sure. I suppose, though, in the given environment, we might expect there to be a little bit more sell volume at the beginning of the contract from people putting the basis trade back on. Let's put it that way, yeah? We might get a little bit more selling on there, but probably not yet. Probably not until the first of the month, essentially. And so with that, let's go and check if our ratios are correct right now. That's when the contracts change. It's possible that the inter-commodity spread ratios change as well. Okay, so I've got the knob spread is 5-2. And the 2 and 10 is 2-1, except for that there's a split, so it's actually 4-1. And then the 5 and 30 is 4-1. Okay, so none of them changed. Well, you got a pretty clear rise in the dollar there off of this. Well, this is kind of the unusual. Well, and let's not say the unusual, but this is a different correlation from what it was before. So the dollar up. Well, not a different correlation, just it's the other way around. Normally it's like interest rates going higher, good for the dollar, right? But the dollar was moving down yesterday. I wonder, do you have any ideas on why the S&P 500 rallied as hard as it did overnight? Was there like really, really good China news or something? Not. EU, US yields tumble after German CPI and EU and industrial confidence slump. Okay. So I guess I need to just appreciate the winner that I caught yesterday and sit on my hands here today, probably. Unless I really start to see some aggressive behavior. Can you explain the relationship between oil and other instruments that you have on the DOM? Well, so first of all, we have oil up there now on the DOM. Not because I intend on trading it or anything like that, but oil is probably the next most common instrument that traders look at and trade. And I do think that if you have the capital to do so, that oil is a market that you could play in. I don't understand the oil market in nearly as well as I wish I did, but I do think it is possible to develop that edge over there and to just follow everything about OPEC and oil and, really study that and know what's going on. Now, oil has kind of a much more complicated relationship with the other instruments than, let's say, the S&P 500 and the treasuries do, right? Now, the S&P 500 and the treasuries, that relationship is interesting because it does flip, and trying to determine when it will be which way is kind of an interesting thing, and in some ways counterintuitive. With oil, it's kind of more like most of the time they don't care, but then every once in a while oil will become like the star of the show, and you'll see other things move. So with treasuries in particular, one of the things that you're gonna want to keep an eye on is higher oil prices can lead to more inflation. So it's often the case that oil moving up will result in treasuries selling, and vice versa. That correlation is very, very loose. So it's not one that I really think that you could rely on very well, but it does happen. And you will want to be aware of it when it does happen, right? Similarly, higher oil prices is usually not good for the economy. So you can see instances where oil moves up and the S&P 500 moves down. On the split side, if the correlation is the other way, you'll also see situations where there's a risk-off move, right? The S&P 500 is selling, people are buying treasuries, right? And in that situation, I would expect that to be affecting oil demand or anticipated future oil demand and see oil sell as well. So you still get those kinds of complicated relationships that flip depending on what the macro driver is. So you always want to think of it as, where's the money coming from and to, right? Like, the money doesn't just come out of thin air. Well, it does. It comes from the Federal Reserve, right? But once the Federal Reserve puts it in the system, how does it get into the markets, right? Banks are going to take their money and they're going to put it in assets. And sometimes they will take it out of this asset and put it in this asset. Sometimes I will take my money out of the market and put it into treasuries because I'm expecting a recession or what have you, right? So where's the money coming from and going to? Now, today we have an interesting situation in oil just on its own. I don't know if I doubt that it's going to affect the other markets, but it is something that we could maybe keep an eye on. But we've had a situation with OPEC where OPEC can't seem to agree about what to do. Especially, I guess some of the African countries want to continue pumping oil, whereas OPEC kind of wants to reduce the amount that they're pumping. So this is a common issue with a cartel like this, where, if you pump more, you can make more money because you have more product to sell, but you'll start to reduce the price, right? If you have too much supply. And so OPEC wants to kind of keep supply at an optimal level where it doesn't harm the economy, but the price is still high and they make the most money. But they're having a disagreement. And they pushed their meeting back. That has been creating big moves in oil, although I would say that overall prices is within its range. But when you get headlines like that, you get big moves up and down. We have the oil stocks today, so it's going to be interesting to see how the inventory numbers affect oil given that backdrop. If you get a strong build, for instance, that I think could be a little bit more devastating than normal. If people think that OPEC isn't going to reduce their output. Oh yeah, I guess that's all that I can really say about it. So while I was discussing all of that, the dollar has started another leg up. They are now on the move towards 102.9. The treasuries aren't necessarily. I would say that I am seeing some shifts in the liquidity over here in the treasuries that do seem to be related to when I'm seeing the dollar move. You could see like big ticks just happened there. Where was it? They took a bid off at 0.3. I see. So it's on the inside. Anyways, you're seeing big clicks, but it's not actually moving off of that. So that's very curious. I would anticipate that the dollar going higher would maybe push the treasuries a little bit lower, but that's not what's happening at the moment. So just seeing the in the yen, we're getting some selling in the yen. Treasuries aren't following that correlation as closely. That's definitely what we got going on there. So other assets we got here. The Japanese yen seems to be the clearest. Well, let's say the yen and the dollar When you look at the euro, the correlation isn't quite as strong, but it's really strong when you look at the Japanese yen right now. The dollar is moving up and the yen is moving down. Oh, you know what I need to do on the yen is I need to add that inverse indicator here. Circulator set free inverse. I actually got a couple of things I should do here. Hold on. First of all, I feel like that window could be turned a little bit. That's maybe a little bit. I feel like I really have to turn my head to see that one versus over here. I don't feel like I'm doing that. So I don't know what the deal is with that, but whatever. Okay, so my spread says 147.37. What else was I gonna do? Oh, you know, I want to come in. I guess I'll show you guys as I'm doing it. I'm gonna make some changes to these charts over here. On ZN, I want to have a line at time 620. Make it a dotted gray line of width maybe 2. Okay, it needs to be brighter than that. Let's try white. Oh, is that actually doing it? Huh. What's with that? Oh, because it doesn't line up with the bar. That's why. So I need to say 630 essentially. Back to gray. There we go. That was a little bit better. So now you can kind of see how it was like really strong up move yesterday. And I want to do the same thing over here. Add the line at time, do it at 7:30. Yeah, that's good. So I can see when the open was. And save that. All right, so where are we at? Oh, the treasuries came back up there really hard. Well, the dollar came back down as that happened, though. That's interesting. So strong pushback in the Japanese yen. So I remember saying if we start to get back onto the upside that I might have to consider taking a trade again. I think it's a little bit risky though at the moment. to say, this has been kind of an odd day. I think what we must be seeing is there was quite a bit of room made in the options for there to be volatility around this news. And then we didn't really get any news, and they're probably selling the volatility with a vengeance again. I think in that situation, for us in the treasuries, that we would want to buy the treasuries. But there wouldn't be a lot of upside to it. So, like, I don't think that we could buy the top of that swing, for instance, right? It might come back a little bit. We might come back to 05 half, for instance. But, yeah, 05. Because they might, on the inventory cost basis, they might just shift back and forth across between those two positions. Let's see if I missed anything on Twitter. Eric Wallerstein, quantitative tightening has not drawn any funds from bank reserves, which are up 140 billion since quantitative tightening began. Fed's quantitative tightening has been almost fully absorbed by lower reverse repo facility and amid higher bill supply and MMF's extending duration, says Cabana from the Bank of America. That is, I don't know what that means exactly, but at some point in the future, that's going to be important. We want to keep an eye on that. Mohammed A. El Arian, the dividing line in the analytical inflation discussion is now between those who believe that the last mile will pose greater challenges compared to what has already transpired, e.g. OECD, and those who believe it will be easier, Goldman. Okay. Here's some comments about Charlie Munger. Aswath Damodorian said, in a world full of self-promoters and false prophets, Charlie Munger was a beacon of common sense, delivering deep lessons on investing and life in simple words and with humor. He is irreplaceable. Champion reader, one good eye or not. He was God's gift to the book publishers. His eloquence was of the strong, fearless American business type. Think of the stereotypical college English professor. Munger was the polar opposite. Oh, look, they are going to come back to the 05 like I anticipated. That's pretty wild. And it came back quite aggressively. So it coming back to 05 would maybe be a spot for me to be like, oh, okay, so if we are going to turn to the upside, I would really like to get a fill there, right? But we are in a little bit of a light liquidity area. So for me to take a trade over here in the micros, I don't think that's probably not a very good idea. But I think that we could start to play around with the sim trade over here to see if we can catch some of this range. Here's an interesting comment from Brannigan Barrett. We all have biases in our trading. The trick with a bias, accept them. They are natural, but ensure you have safeguards in place to mitigate the risks associated with these biases. There you go. And then he has a video. Is that an Axia video? Yes, it is. Yeah, maybe I'll watch that later. I haven't watched an Axia video in a while, but did I get the second contract? Yes, I did. I'll take another one right there. Almost. We could get filled there. Man, it's been a long time since I've been having to play the queue like that. Almost. They didn't quite fill me. That's not good. There is a good iceberg there at 0.4.5 though. Okay, cool. So I'm thinking about this and I'm like, normally I would be trying to get one contract that could run in case they break the highs. But in this situation, because I'm anticipating a crunch in volatility, I don't think that I want to go for a take profit that's above the buyer's cost basis at 0.8. So this is the first time I've tried doing something so explicitly based off of the inventory cost basis. But it's a range bound trade that I've always kind of theorized about. So let's see how well it works for us. But the idea is to just scalp between the buyer and seller cost basis lines on my chart here. Well, they built an offer at 0.4.5, so that's not particularly the best thing for me. All right. Starting to get not a whole lot of volume. It is look tilted to the downside though. One of the key lessons we can learn from Charlie Munger is his obsession with being a student of the markets. Regarded as an expert by most, yet he continuously strived to progress. He dedicated his entire life to investing, and he only started his investment firm at age 42. He gave 57 years of his life to investing. Hasim Nicholas Taleb, the core of the misunderstanding of statistics by idiots is that the law of large numbers does not work for you, only for huge samples. It is only actionable for traders who tend to do more than 100,000 trades per year. Lecture on particularizing the general. Ooh. Oh, hey, look, my other got another one there. If I'm so lucky, I'll take it again. I don't know if that one at 0.4.5 will fill this time. I'm kind of considering moving that one up. Is this a new mini lesson from? No, this was 2 years ago. Oof. Well, I got filled, but not in a particularly good way, was it? I just got buried there. Well, sometimes when you get like a big lot put on top of you and stuff like that, you might be thinking, oh, it's a spoof, right? But we got shoved down 3 ticks there. And the dollar started moving back up again. Hmm. If I don't see it start to mean revert back up, I think I'll just dump this. There is some absorption at O2 half. See, this is interesting because again, I'm anticipating volatility to clamp down, and I just saw something that kind of suggests breakout, right? So the flow there, now it could be a trick, but I would say that the flow at that moment was not very in line with what I was expecting. Okay, so it is going to cross back over here. So I'd say pretty light liquidity still. Yeah, flow is flighty. So it's kind of interesting. I mean, there was a 3K there, right? It's not there anymore, but the market is being very, very sensitive. You know, the treasuries do tend to be a little bit more sensitive at the beginning of a contract, but this is a little much. Let's not say sensitive. Do you think the 6J DOM is more useful than CL? So you know what? You're probably right. At least within the respect that you know, the Japanese yen correlation is really important. But the order flow in the FX futures is very, very different. And so if I had the 6J DOM up here watching it, I don't know if I would be able to interpret it correctly. I'm sure that if I just traded the Japanese yen for years, I would figure it out and what's going on there. But I don't really understand it at the time, and it's the FX futures are very different. Like just as an example, the situation where price is moving up and cumulative delta is selling the whole way is a lot more common in FX futures. So well, we did get a pretty decent retracement of that down move, but they didn't come back to the 05. I didn't see like a hard cap up here. Like on the chart, you would say, oh, there's some resistance at 05, but that was just because they weren't really going for it. It wasn't because they couldn't get through it. I don't think order flow works on Forex due to lack of centralization. Yeah, basically, well, so here's the thing. When you look at an instrument, okay, in order for us to tick up, the offers have to be taken out by the bids. Now, that can happen a couple of different ways. It could be that the offer is what it is, and there's just more bids than that. But it could also be that the offer pulls away, and there's only a few left on the offer, and then they take it out, right? But that has to happen, right? So you can still see that dynamic when you're watching it, right? But if I'm looking to see, is there a large meta order in the market? Is there more buying than there is selling over the last 30 minutes? Doesn't really tell, you know, what you're seeing in 6J is because, like you said, it's not centralized. Or which is to say, where is the volume really happening? It's happening between banks, and I can't see that. Come on, come on. Okay, so I did get that other contract. Yeah. So it's kind of an interesting thing with the flow. So like when I look at the treasury market, for instance, is a good example. They've done research, and the research suggests that the order flow in the 10-year treasury is where price action originates, which is to say, like, they look at like which market moves first and which ones follow it and everything. The futures tend to move first, then the cash follows it, actually. And options is also a key factor in there too. If you have options are often the ones that are the driver, right? S&P 500, it's a little bit different because it's an index. So yes, if there's like a big macro change and like the whole market is going to move, it often originates in the futures. But then there's a lot of movement in the S&P 500 that's just kind of random and you can't anticipate, right? In Forex, on the other hand, the driver is interbank transactions, which I can't see. So when I look at the futures are telling me something, but it's a much more complicated picture. I have to sit down and say, okay, these, we're moving up, but cumulative delta is moving down because these guys are hedging. And what could be the reason that they're hedging it, even though it's moving the opposite way? I don't know that instrument very well to know what the possible theories could be, but I'm sure that they exist. Back in late 2022, I used to trade ES without the 10-year, and I can't imagine how I did it. I missed out on so much context. Yeah, oh, totally. The liquidity holes always appear. I would say that they're completely disconnected from what correlations are, right? Because one thing that you could see happen is a liquidity hole form in a particular market, and you think, okay, I'm safe for now because this probably isn't going to go anywhere, and then have a correlation start moving against you and have the market get pulled out of that liquidity hole anyways, right? That would be one of the things. Oh, does it always appear after autocorrelation? Yeah, I totally misunderstood the question. Sorry. It will always, well, okay. After a large meta order almost always tends to result in some amount of a liquidity hole, yes. If you have a 10 to 15,000 contract change in cumulative delta on ZN, you're going to start to see a liquidity hole. Yes, there was I made the same mistake, Kevin, and Octavius had to tell me to switch over to March. But we're 3 business days before the end of the month, so it is time to roll over in ZN. I would say, though, that in March, the liquidity isn't necessarily very good either, though. So, I don't know. So I really harp on the liquidity hole of way of looking at it, because that, I think, gives you the mental model, a better mental model to know what you're looking for on the DOM to identify if a liquidity hole is possibly forming. Okay. But another way of looking at it is square root law, right? Square root law is the square root of 0.01 is 0.1. I should pull my pen out here. Pull my pen out, and I should do it like, okay, the square root of 0.01 equals 0.1. The square root of 0.02 equals 0.1415. for ... right? So we doubled the size. We only got 50% increase, essentially. Less than a 50% increase, okay? Square root of 0.03 is, I don't know, but it's like 0.17 or something like that, right? So it's more, but it's not double. So it looks like this. So that's kind of where it gets kind of interesting with the square root law, is like, okay, you're going to start to see it happen where it's getting harder to push. That doesn't mean that it can't continue to push, right? It can totally continue to push. It's just, it'll take about 50% more contracts to be able to continue moving in the direction of the trend, right? And my observation is that in treasuries, 10,000, 10K like that is linear. And then that's when you start to see it come in. And once you get to something like 30K, 30 to 50K, it's like, it's really hard for them to move from that. Unless it's just become an unhinged market. It's crazy how thick the bonds are, but on NQ it's the Wild West. I just can't believe why so many people want to trade NQ. I think it's just absolutely bonkers. But you know, like the funny thing is that 2,000 contracts here in the treasuries is kind of a little nerve-wracking for us. We're not, like, the way that it's been moving here today, I did not take a trade over here in the micros. It would have only have been $10, $15 over here in the micros. I did a sim trade instead because I didn't really like the liquidity. It looks like it worked, although I had to take quite a bit of a drawdown in order for it to work. And I haven't gotten the order filled at 08 yet. That might be tough. We'll see. Yeah. That was a pretty good uptick. Didn't result with not very many buying at 08, but yay. I'd say overall, for the experiment that I was doing and the reasons that I took that and everything, that worked out almost perfectly. I could have gotten in, I could have waited to get in a little bit because there was that kind of like really bizarre head fake against me. But I held on because I know that one of the things that I see a lot, or that happens to me a lot when volatility is constricting, is you'll get to the point where it's about to reverse. It'll go way further and it'll make you think, oh, maybe they're breaking out. Maybe this is actually going to be a trend. And as soon as you sell it, then it reverses, right? That's exactly what happened. So they didn't fool me that time. I'm interested to see. Let's clear this above us. How far above 08 can they get? I use previous TPO data points to get my custom system to context. So, this kind of goes back to this thing that Nassim Taleb was talking about, where he was like, you know, the law of large numbers is only relevant to people that are really trading large numbers, like 100,000 contracts a year. But I also have a problem with TPOs and so forth, which is that I'm not convinced that like a previous area of large volume and things like that are really relevant after 45 minutes. After that point, I believe that the liquidity largely heals and they're not relevant anymore. And I have a video about volume profile. This is kind of, you know, it's volume and market profile. They kind of pretty similar. The same things apply to both of them. And, you know, I'll go and do the statistics and it says that, yeah, there's not really anything there. Not something statistically significant, at least. That whatever edge people think they're pulling out of it, the edge that they're actually pulling out is changes in volatility, right? That is very natural, as the orders will get pulled in the market always moves more than you'd expect, because that's the whole point. Well, the market always moves more than you expect because new orders have a very dramatic impact on market prices. Yeah. So like, the thing is we saw like a move down and then a move back up. It might have been only 1,000 contracts that caused that little plunge, for instance. You know, it's like way less than people think. People think, oh, to manipulate the market, you'd have to have billions of dollars. It's just this crazy amount to... No, it's not. The impact of orders is 5 times larger than you anticipate. So it does always go more than you expect. And surely, if you were looking at like a TPO or something like that, and you said it's going to go to this TPO and it's going to reverse, then that's probably not a very good trade, right? It usually goes right through you. But you know, I'm just trying to point out this, like, a lot of these technical analysis theories are basically, I go and I do some sort of statistical analysis of the market over a 2-week period, and I see this statistic. And so then I'm going to trade based off of that statistic. Well, you don't have enough data to prove that that's statistically significant, first of all. But then second of all, if there really is a real statistically significant thing there, why? Why does it do that, right? And if I can't come up with a reason for why it does that, I'm very suspicious about trading it. You know, I want to know, what is the market microstructure behind that thing, right? Most people think of technical analysis as that's the tendency of markets because that's human behavior, and human behavior is consistent. It's wrong. Humans are so random, guys. Humans are so random. And you can see 2 situations in a society that are like almost exactly the same, and you could see people react in completely different ways and see completely different outcomes, and it happens all the time. There's so much randomness to it. And to go in and say, this is the way that people tend to behave, and then try and bring it down to the particular and say, that means that this person is likely to do this, that's a crapshoot. It's not going to work. But what I think does work is to say, okay, here's what's going on today, here's what the flows are, and here's what they're going to do based on those flows. So I've done an okay job so far to say the market was anticipating some volatility for GDP, but overall they've been selling volatility. So because the GDP appears to have been a little bit of a dud, you're starting to see significant amounts of mean reversion and selling of volatility, which means you're going to get head fakes, but that assets are going to overall move to the upside. Right? Now, this move here in the S&P 500 is a little bit more than I would expect. Maybe I would sell that pop. But I wouldn't sell it, but maybe I might. If I was really going to make a trade, maybe I would wait for it to come back, take it again, right? Because I'm anticipating mean reversion. And I know that just because I know what's been going on in the market. Realizing true price where people are willing to trade versus price on market where people have to trade. Well, so then you're talking about like stop runs, right? So recognizing when like a stop run is actually happening, that's very true. That's a super hard thing to do though, especially in the E-mini, man. Because the E-mini just will move, you know? Do you believe the dollar to be the driving force for these markets? You know what? If you had asked me that 30 minutes ago, I probably would have said yes. But now that this entire move in the dollar has retraced, I'm not sure. It does seem that there is some correlation between like when the different points shift between the dollar and the treasuries, but it's really effing confusing. Well, yeah, it is. As it's retracing, the rest of the markets are, you're right. But the markets didn't sell super hard when it was on a tear up to the upside. That's why I'm kind of like, the currency is definitely involved in here, but it's kind of a really complicated correlation here. Okay, so now the treasuries are at the 10. So we're starting to get to the point where I was saying like, okay, there is this one scenario where if everything kind of turns to the upside, that I might want to take it. I'm not getting very good risk reward, I tell you that. I think that I could have gotten 429 if I had taken that, back when I took that trade. I do need to be careful though, because I do think that the upside is capped, but I do think that they'll probably break a new high. So if you haven't watched my video on inelastic market hypothesis, go and watch that. And that kind of explains how the markets are much more sensitive than we think that they are. This may just turn into a bubble up sort of thing again. Maybe I shouldn't have said if you'd asked me 30 minutes ago. If you'd asked me right after the move, I would have said yes, but then 30 minutes ago I would have said no, and now they are kind of being driven by the dollar, aren't they? They're buying TLT, huh? I think if we maybe like came back to 08 and I saw some support, then I think you would then I would feel more comfortable taking them along. The inelastic theory is interesting, but I don't think it will get me any closer to actually making money. Yes, it will. So I'll explain to you why it will. Well, what it will do is it will help prevent you from losing money, right? Because the inelastic market hypothesis basically disproves two really key incorrect ideas about markets, right? So the first one about markets is that markets should be driven by fundamentals, right? That the market says, based on all of the information that I have, the price should be X. And they keep buying until price gets to X. That's not what actually happens. They just say, market's too high or too low, they buy. It moves based on how many people decide to buy or sell. And sometimes that's more contracts than is necessary to get, and sometimes that is less. And so the move almost always over or underestimates what it should, right? That's the first fallacy. The second fallacy is that markets are really stable and that it's really hard to move and or manipulate markets. The reality is that markets are very, very sensitive to new orders. They're about 5 times more sensitive to orders than the average person would anticipate. Adding $1 to the S&P, investing $1 in the S&P 500 actually adds $5 to the market cap in general. So the market is inelastic. So a lot of these ideas that people have about, like, here's a chart and here's support and resistance, and that is going to hold because, there's all of these people that want to sell it there and yada, yada, yada. Well, markets are very sensitive to new orders. So it actually doesn't take that much. It only takes one big guy to say, we're going to move higher, for it to do it. Right? Now that you have that kind of framework and that understanding, that really kind of narrows the field down in terms of what you're going to do. Right? See, one of the thing that I would caution you against is to say, okay, here's a piece of information. Does this piece of information directly lead me to a trade that I will make money from? And if it's not, then I don't care about it, right? I think that that's a bad approach, because how are you going to find something like that? Well, you're going to find it by combining everything else that you know about the markets, right? So it's going to be, you learn this thing, you learn this thing, you learn this thing, and then you're going to, now you know where the frontier is. Now you know where to search. And now you have the ability to take it a step further. Whereas if you're not doing that stuff, you don't know those things, you're kind of behind, and you might end up going and digging in places where people have already dug, essentially, and you're just always behind the curve. So you want to learn as much as you can about the markets in order to, in the hopes that that information will eventually lead you to other information that can actually be a real trade, is the first thing. The second thing is that sometimes you might not realize, you might not see it. Might be that within the inelastic market hypothesis, there is directly a way to make good money out of the markets, and we just don't realize what the strategy is to take advantage of it. Right? So we should never dismiss a piece of correct information about the markets. If there anything that we can prove about the market, I want to know and understand. Right? So the treasuries did breach a new high. But the question now is, how long can they keep that up for? So it's a regular session high. The overnight session high is like still quite a bit up there. You're so underrated. It pisses me off seeing people like you have almost no following. If I found you in 2018, I'd give my arm for it. Right. Well, yeah, it's totally it. It is frustrating that, like, I mean, because I went through the same thing too. Is like, I wish that I knew all of this stuff about the empirical behavior of markets, because I wasted some time on some ideas that were kind of pointless too. And like, the thing that was frustrating to me was that I always kind of knew the answer. Like, somebody came and told me the answer at the beginning, but because I didn't know how they arrived at that answer, I didn't think about it correctly. I didn't incorporate it into my trading correctly, and I didn't truly trust it. Well, yeah, experience is a big part too. But I think this comes back to this thing we were talking about earlier about Charlie Munger, that he says, you know, if you want a step-by-step process, go to graduate school where they'll teach you a process that doesn't work, right? That markets are very competitive and sophisticated, and so really simple processes like that don't really help explain markets, don't really help you. You have to be more competitive than that. And I would argue that the thing that humans can do that they're really good at and that machines can't really duplicate yet is our frontal cortex. If you take all of this information, your mind will incorporate it into that network, and you might not understand how, but it does. And then it takes all of the market data that you're getting right now and it spits out an answer and says, this is what's going to happen. And you'll just know. You might not know exactly how you arrived at that, but you'll know intuitively. And that is your neural network at work. So experience is very, very, intuition. I think Lucas wasn't around for but that's what I would call intuition. What I call intuition is your neural network doing processing, and you don't understand how the neural network is processing it, but you know that it is the neural network that's processing it and that it's coming out with an answer, right? It's not, I'll just sit here and do what it feels like, right? It's a scientific explanation of intuition, because I think that most people's idea of intuition is, the universe wants me to make this decision or something like that, right? Well, that doesn't really work. But if you're taking all of this information in and you're trying to make decisions based off of that information, but the neural network gets processing it in a way that we just don't understand, and you just get the answer and you'll know. And that's intuition. Yes. And in order to build that intuition, you need experience, right? The problem is that people build that neural network with assumptions that are false. So some people get lucky and their network comes out to become really effective at this on its own. What I'm saying is that if you know all of this information about the market that we know is true, and you're incorporating that into your network before you even start gaining the experience, you're much more likely to come out with a model or a network that's effective, right? Yeah, we are saying the same thing. I was hearing what you were saying, and I was like, okay, here's like the detailed explanation of what that is. Because that's another one of those things where it's like, okay, we have these ideas about how to approach the world and stuff that maybe we were taught by other people, or we just kind of came to through our own intuition. But now I'm explaining to you why it works that way, so that you can make that process happen intentionally, and that will dramatically increase your probability for success. Right? Basically, I'm giving you a framework for how to build intuition intentionally. But it starts with taking all of the information about the market that we know and can prove to be true. The thing that makes navigating markets so difficult is that there are a couple of really key discoveries about the market that are just counterintuitive. They are not what people think. And so everybody is building their network with faulty assumptions. Once you realize it's the orders that move the market, the orders are very, very impactful on the price. Now I can come in and I can say, well, what are the orders that I know are going to happen today? Combine them together. And then that's where the intuition starts to come in to say, okay, X, Y, and Z things, it's going to be this way. Because I can't necessarily come in and say like, okay, X times Y times Z, and this is the number, and that means buy or sell, right? I just say, there's this thing, and I think that that's going to lead to an imbalance. Just like today, I said, I think that the flows are mixed we're going to see some contraction in volatility. But if I do start to get some upside trend, I'd be more willing to go along with that. It did turn out that way, didn't it? It's range bound, but slightly tilted to the upside. And would have been really hard for you to have caught points, although I totally called it, I totally got the 05. They pushed it against me, but that was only a small one, relatively speaking. I was only looking for the range, though. Could have gotten more out of it. It's okay. Buying futures was a game changer back in 2020. I was still on SPY options, and that so many times I was right but never made money. And when I focused on risk management, then I lost almost every trade with options. Yeah, well, because you'd need to be the seller of options in that situation, right? It went my way and I closed for a profit, but that one time I did hold and hope it would take it all away with just one time where it didn't do risk management. Well, okay, so this is where we got to come back to this whole thing about the law of large numbers and so forth, right? So the thing that you've got to understand is this. If I take a Gaussian distribution, okay, so Gaussian distribution is like if I say, how much money did I make in a day? And I take a graph here and I say, this is the number of days that happened. And this is how much money I made, right? And you want a Gaussian distribution is something like this, right? Where most days I make money, and some days I lose a lot of money, and some days I make a lot of money, right? Now, ideally, we would want something like this, where most days I make money, and some days I make tons and tons of money, but there are very few days where I lose a lot of money, okay? Problem. Tails. So these are events that are so big. There could be this point like way out here where you would make or lose so much money that it would completely dwarf this whole area combined. Everything that you would have made and lost over here is completely canceled out by this. Okay? But actually, it's usually over here. So why is that? So what you're doing is, if I draw this again, here's the Gaussian. Here's just a normal Gaussian distribution centered around 0. Okay. What you're doing with your risk management rules is you're saying, I want to win. So you're making it easier for you to win. So you're moving the distribution over here. And you're making these lines steeper, right? Most of my wins happen like this, and then I quit, right? And so when you do that, think of it as like this is like a piece of rope or something, right? And if you squeeze the top of this in like this, what happens is these tails get pushed out, right? So what happens is most traders' approach basically exaggerates their far left tails, right? So the simplest way to accomplish this would be to have a target that is closer than your stop. So if you came in and I took 4 ticks, I'll win, but I lost 8 ticks on a loss. Okay, now can that be a profitable system? Well, when we assume everything's Gaussian, I can come in and I can say, 4 ticks times a certain percentage, my win rate X, minus 8 times 1 minus my win rate, right, is greater than 0, right? My winners are greater than my losers. Is that possible? Are there variables of X for which that works? Yes. If X is like 80% or something like that, right? Okay. The problem is that assumes Gaussian, and these markets have fat tails, right? So what's going to happen is that's all fine and dandy until that one day comes along and you blow the account, right? So now the thing that's really nasty about this is, again, this tail event that's over here, okay? That might happen once every 2 years, right? This might happen if you have 10,000 samples. This might happen once. So can you imagine that? That out of 10,000 trades, one matters and completely cancels out all of the other. But that literally happens, right? And so you're coming in and you're trading and you're back testing, or you're just trading it live or whatever, and you've been making money for a year, and you go, oh, this totally works, right? But actually you don't know that because you don't have enough data to know that your strategy is able to deal with the tail events. What usually happens to traders is that have success or use these kinds of strategies is they'll be successful for a year or two. Say, I'm a profitable trader, and then they'll blow the account and they'll say, that was just a mistake. I won't make that mistake again. And then you start out again. And you go through that cycle over and over again every 2 years. That's what they do. Because you're fooled by this, right? You're winning every day. Your brain says this works. And then when the thing comes along that proves that it doesn't work, your brain just dismisses it. Right? That's the thing you got to be careful about. Yeah, they're still going here in the treasuries, so I think maybe this is gonna turn into something more. Yeah, puts it into perspective. They have hard limits, and some days it's just not it. And yeah, hold on. Oh, whoops. I think I'm in that post-viral infection time period where, like, I still get a cough or a runny nose, but there's not really anything coming out. So it'll just kind of build up, and then I'll feel it in the back there, and it just makes me want to throw up. Yeah. Now, one of the things is, okay, so you want to limit the tells, because this is another fallacy that we run into is... or that took me a long time to understand, is that, okay, you get this distribution. This is bad. So here's what I do. I set a daily limit for myself. If this is the distribution of daily profits, I say, if I lose more than X, I stop. Right? So now... my distribution looks like this. There's going to be a little bit more losers here at this point, but it stops right there. And then your distribution looks like this, right? Okay. Well, the problem with that is that that's just daily profits, right? What if it's weekly profits or yearly profits or whatever the deal is, like, right? You could, what happens if you run into this hard stop 5 days in a row? Because most traders' accounts, you get that more than 5 days in a row and they'll blow the account, right? So how do you deal with the fat tail, right? Well, the way that I deal with the fat tail is I'm not just relying on a Gaussian distribution. I just ignore this entirely, and I say I want to know what's going to happen. And unless I have something that's really effective at predicting to me what's going to happen, I don't get in. And that reduces my tails. Now you're able to get this system where you get good variance, and every once in a while you catch one that's really, really big. And the losers are pretty limited because, you know, if you're wrong, if you really know what's going to happen, then if you're wrong, you'll be able to tell that you're wrong very quickly because the flow is just not going to cooperate. Right? I had this discussion with someone on Discord. He was complaining about always losing money on trend days and how to solve it. If you understand trend days, as Fat tells you, will know there was no edge to begin with. So possible solution of having a hard stop for the session would imply not making money or even losing on non-trend days. Yeah. Or so like the way that I would approach this is there are different types of markets. Okay. This axis is trend. Let's see here. Trend. Liquidity. Okay. High trend and low liquidity. This is news. Right? High trend and high liquidity. This is a bubble up. Bang. Low trend and high liquidity. This is a range bound. And low trend and low liquidity is what we kind of use as a flighty market. Right. This is where it moves like really far back and forth, and it's kind of like, what the hell is going on? Why does it move so quickly, right? Okay. So now I can be based on these two measures, I can categorize the market into 4 different types of categories. And I'm going to take a different type of trade depending on which type of market we're actually in, right? So what I tend to say is, if the liquidity is bad, like this, these I just don't trade. I just don't trade these. I don't feel that as a retail trader that I have the capital buffer to be able to trade these. Maybe if you're a millionaire, you could trade these, okay? Ones that are really super range bound, I also don't trade. Because this is where the market maker can just absolutely mess with you, right? So really what I would prefer is a high liquidity, high trend move. And that is bubble up, up, down, large meta order. Right, so this is what I prefer. So I can either say this is the one that I prefer and only trade this, or when it's in these other ones, I have to use different strategies, essentially, right? Problem. There's a problem. How do I know which type of market it's going to be today? Because I might be able to say, today was a low liquidity, low trend day, at least at the start. Okay. But how did I know that it was going to be that? Because in order to change my strategy, I need to know what type of market it is before I take that trade. And most of the time, you don't know that it's that kind of market until you get stopped out of the trade, right? Well, this is where we're using the way that I'm dealing with that problem is I'm taking all of this information that I know about the market and able to predict the liquidity and trend conditions based on what kind of institutional activity I'm expecting and all of these other variables, right? All just combines together and it spits out an answer. Right? So basically, the solution to trend days is to know it's going to be a trend day before it happens. That's the whole issue. That's the whole issue. The reason that retail traders run into this problem is because of their desire to have this set system that they just follow all the time. When I see this chart pattern and this candlestick set up, I take this trade and it always works. No. You've got to know the market conditions. And you can only know that if you have some way of predicting the future orders, essentially. Right? That's why I go back and I say, just forget everything that you know. Let's start with a completely fresh model. And what is that model? What do I know about the market today that could potentially predict flows? And then we start talking about all the things that we know for today, because there's lots of different categories. We know what's going on with volatility, and volatility is contracting right now. Okay. So that means range bound action slightly to the upside. So that is some flow slightly higher, right? We're at the beginning of a contract, which I suspect will be a lot of selling for basis trade. But maybe not yet today. So that one's kind of like mixed. We have Federal Reserve speakers today. They were dovish yesterday. They might push back on that today, but that becomes a risk, so we don't really know. And then we had, of course, the big one, the GDP news. Well, I don't know about that. That's been really good and it's been really bad. So I don't know. I don't know about that one. Oh, here's Barkin speaking. That move down might have been because of Barkin. Okay. So when I combine everything that I know about today, the answer that I come up with is it's going to be range bound, and I'm not really sure if there's going to be a strong trend one way or another, but if I was going to go for a trend, I'm slightly biased towards the long side. So how did I play that? When I saw it come down to my cost, to the market maker's cost basis, essentially at 05, I said, okay, I'm going to build a position here and just take a little bit out of the range. Worked beautifully. I'm not sure I could have done that one any better. Of course, there was that move against me at the very beginning. Now, how am I going to know that one's going to happen, you know? Maybe if I was willing to have traded that one with larger size, I would have doubled down after they'd done that one. But to do that, I have to really, really trust my edge, right? My prediction of the flows, right? Okay, but now we have this whole framework, and then we combine that together with the stylized behaviors of markets. Markets are inelastic. There tends to be strong autocorrelation with orders because of the existence of large meta orders. There is a square root law. Now I can combine this all together into a thing that is, okay, here's what I'm actually going to see, right? It's going to be range bound, so you're going to slightly to the upside, so you're going to get something like this. Maybe. We're right here right now. I think that it'll probably be a little bit more like this. It'll probably be a little bit more like, so we had this, and then this, and then we went higher. I think it's going to come almost all the way back down, and then it's probably what it will do. Right? I have to combine all of those things together into my neural network to be able to come out with that answer. That's how you deal with trend days, right? The beauty of that setup is when the trend day comes, you'll hope and pray. Like, trend days will be the easiest days for you to trade. Trend days are the easiest ones for me to trade if I catch them, right? It's been a while, but you've all seen those, right? I'll say, I think the flows are going to be tilted this direction. I take a trade like right within the first 5 minutes of the stream, and I just hold it the whole stream. And I don't have to do anything because I know it's going to be a trend. Yep, there you go. Every retail trader does well on non-trend days because their strategy relies on taking excessive risks to realize profits. This blows up on trend days, and this is where 95% of traders fail. Exactly. I mean, it doesn't have to be that way. Like here's the thing. If everybody that went into trading understood that, I think that you'd still have a lot of traders fail, right? But this is kind of where the human nature is that we don't understand fat tails intuitively. But yes, basically, if you know what type of market it's going to be, you can then use a strategy that is conducive to that market. One of the things that I would pay attention to is that most of the retail day trading strategies that you see out there, because again, what they're doing is they're just looking at the past data and trying to find something that works with the past data, and they don't necessarily understand why it works or if there's actually a statistical anomaly. Okay, I think that most people, the anomaly that they had been taking advantage of was by the dip. Essentially, like when you look at a lot of these things, it was essentially there will be a breach of the lows and then you buy the dip and it goes higher. That was, for instance, the smart money concept stuff. That's why it did so well in 2020. And then after the 2021 market peaked, it started to just be dismal. And the issue is, when we look at the economy going forward, what kind of market are we likely to be in? Are we moving back to a buy the dip, lots of liquidity type of market? Seems like no. If we have a recession and they bring interest rates back to zero and they turn the money, then it would be, right? And then I would start trading all of those things. It would just, and it wouldn't, you could make it way more simple than what they do. You just wait for them to sell it and then buy, right? But because inflation is a concern and interest rates are high, we're not in that environment. And so those strategies don't work. Is there some news? ES just did 20 points. I believe that, so first of all, there was. Fed's Barkin has been saying stuff. Markets bet on 4 rate cuts next year might be based on expectations for a soft landing. I hope they are right. Talking about rate cuts is premature was the big one. So this was like, so I didn't know that Barkin was going to be speaking right now, but we did hear him talking. And I did say when we moved down, that must have been from Barkin. So now I'm reading his comments. I believe inflation will be more stubborn than we'd like. So basically, as I predicted, Waller yesterday said something like, oh, well, we could reduce rates if this continues to be like this, and the market rallied on that. And so now Barkin's going to come in and say, well, okay, we're not talking about reducing interest rates just quite yet, right? Because they don't like it. So what I'm about to tell you is entirely speculative. I have no way to prove this, but this is what I think happens. Anytime the market moves based off of something that a Federal Reserve member said, if they have a speech that is entirely centered around this one idea and it's clearly intended to move the market, then that's different. And they absolutely do that. But if they're just giving a speech and the market moves off of something that they said and they weren't anticipating it, then they will always push back against it. They basically are always frustrated when the market moves and they don't intend it to. And you get the comments kind of walk back a little bit. That's what you're seeing. So I think that's what's happening. It's very interesting, isn't it, that the S&P 500 sold as hard as it did? But but we're still in this contracting volatility thing. So yeah, you retraced the initial pop off of the open. Didn't I say when this took off that maybe you sell it? Or if that's too risky, you wait for it to come back down and then maybe you buy it back up? Well, I guess if it's off of Fed comment, I wouldn't want to buy it at the moment, but probably somewhere in here, you're probably going to get it revert back to the open. Yeah, so we've had, it's been, you're right. It's been selling since before Barkin. It was, where was it starting at? 8:05. So it's been about 10 minutes. Well, that was about when he started saying stuff. The worst thing is you will try to explain what's wrong with how they're trading, but this is just futile. They will believe that only if they only fix their psychology, everything else would fall in line. Yeah. And there doesn't really seem to be a solution for it, is there, Lucas? I think about like large institutions. So my understanding about large institutions is that they want fresh people. Like, they want to take somebody that's super smart, that did really, really well at school, and they want to teach them how to be a trader. They don't want somebody that's been trading for 20 years and they've had some success, and then they hire them and they come over and they teach them how to trade. Because essentially, you've built this whole mental model in your mind about how the market works, and then when you go and work for a firm, they're going to completely destroy it. That's what I went through, because by the time I had gotten to, a large institution, I had already read all this stuff and had been spending a couple of years just staring at chart patterns all the time. I had to relearn. Luckily for me, I'm ADHD and I have a really high plasticity, mental plasticity, or whatever we call it. So I'm able to adjust and build that new network. And I was still young, I guess. If I had discovered this stuff after 40 or after 50, then you'd definitely be in trouble, right? Then you didn't stand a chance of overcoming that. I don't think. That's kind of the weird thing is the way that once we understand how we're doing this and everything, age really matters, doesn't it? But here's the rub. Why does it end up being that way? Here's what I've seen from people. If you are with a new group of friends, new group of people, they have a way of thinking. They have this model. I call it a model, but they have this neural network in their minds that has been developed between the group of them about how to interact with each other and all of this sort of stuff, right? And now you're new and you come in and you do something that is completely contrary to that model. What are they going to do? They're going to either correct you or shun you. Why is that? Don't you think, shouldn't it be the case? I would think that the logical thing to do would be if you come across somebody that clearly has a significantly different model from your own, in terms of that intuition and everything, that I would start to investigate their model to understand why theirs functions differently, and then compare and see what were the good and bad parts of that to see if you're right or they're right, or make a better network, right? But that's not what people do. Why is that? Well, my theory is that humans are tribal, and the purpose of this neural network is to interact with each other. That's why this evolved, was because humans are tribal. We're extremely social species in a way that other animals are not. And so we need to have that strong frontal cortex to be able to keep up with the social interactions, and that's all going so fast and is so incredibly complicated. That's why we evolved that. And it's because of the tribe all kind of being in line with each other that we've had success, right? The tribal unity was the thing that propelled humans to the spot that they are today. There were other humans that were competitors that died out because they didn't have the same tribal unity that we did. So that's why our tendency is, once we've built the network based on our social interactions, we don't like to change it, because that means if somebody comes along and they don't have the same network as we do, that means they're from another tribe. They're a competitor. Or even if they don't come from another tribe, that's somebody that I can't trust. They don't think the way that I do. They will disagree with me on things sometime in the future, and at some point they will be a threat to what I want. And so when people come across this network that doesn't agree with them, their tendency is to turn away. I don't have proof for that that's why it is the way that it is, but that's my theory, and I wish I knew ways, or, I wish that there'd be a social scientist out there that could maybe say, hey, here's a study of this and this that backs that up and all these sorts of things, but I don't have that. But I think that that's the way that it happens, right? So the answer may be therein with that, right? So this first thing, it is better if we can catch people before they really build this model of the markets that is completely wrong. But I think that even if they do have that, the way that we get them away from that, and the people that we have had success with here on the stream and taking that approach, and it's improved their trading, it's partly because of the culture. Unfortunately, Seth is not the social genius, so nor am I like the charismatic leader sort of thing. I don't know how you do that. I've kind of tried, but it seems like I'm not very good at it, right? But that would probably be how we get more people in that, to get past that, right? Now there's another issue, and that is the ego, right? Because, when you do something and then you get a reward, and then that reinforces that behavior in your brain. That's kind of how dopamine works and everything. And this is why people that have had success and people that are incredibly rich tend to be incredibly egotistical, right? And it often turns into this megalomaniac kind of syndrome where they step outside the bounds of what they know and they start doing crazy stuff, right? And for somebody that's made tens of thousands of dollars in the market, within a year or something, how do you convince them that they're wrong? There's almost nothing you're ever going to say to that person that's going to convince them that they're wrong. The only thing that's going to convince them that they're wrong is being humbled by the markets. And hopefully, when they get humbled by the markets, they say, maybe I'm not doing this right. But you can't just be that one time, right? They probably have to go through that cycle like 3 or 4 times, and by that point, they've watched out of the market and they disappear. You started to vape? Well, yeah, nicotine probably would help you with trading. If there was a way to get the nicotine without it, because basically it reduces your stress response, right? But the problem is that then your stress response is higher after the nicotine wears off. If there wasn't that side effect, then it would really, really help you. But you've seen that movie, The Big Short, right? And Michael's character, or not the guy played by the guy from The Office, right, is like a chronic smoker. 100% like that, and it's extremely common at these financial institutions. When I worked for Goldman, yeah, there's a group of guys, they smoked hard, which is extremely unusual in Utah. And yeah, when they hadn't had a smoke, they'd start to get super stressed out. So what do you think here now that we've come back? Because we are starting to touch that 05 half area again. And this is where we kind of start to come to the big decision point, right? Do we bounce back up and continue to be range bound? Or was what Barkin said a big enough deal to cause a counter trend day and for the treasuries to just sell the rest of the day? I like trends, and so I always I would always kind of be leaning on the side of it'll continue to sell. But the volatility, I've gotten screwed by that so many times. I'm just not confident on it to make a call here. My original theory was it'll come down here and it'll bounce, and I drew the pictures and everything. Now that I'm seeing how the market's reacting to Barkin, I'm not so sure. Is it yes in a very crucial area? Well, it is at what is it, yesterday's high or something like that. I should change these colors so that I know what they are, right? So I'll say that the low should be orange and the high should be like light cyan or something like that. Cyan. And then the open and the close, I'll have the open be blue and the close be red. Or actually, let's make it light slate gray, and the open being more of like a light, like a ghost white or something like that. How about that? Okay, so now I can see that yes, they are at yesterday's high. Previous day high and lows are areas of interest in the S&P 500, but I don't think that they're very predictive. So. Okay, that nose blowing was very satisfying. I guess one of the things is, given the location that we're at and everything, I wouldn't really like to take a trade because I only got like 30 minutes left. Kind of feel like I made my trade and on Sim and got a win on Sim, and I'm kind of happy with that. You always got to be a little bit careful at the beginning of a contract too. Oh, so I missed this other conversation here for a minute. Oh, you're talking about... Okay, so... You're asking me, how do I quit smoking? Yeah. Ugh. Okay, so here's how you quit smoking. It has to be cold turkey, and you have to replace it with something. That's the two things that I have found. Everyone has been catching the cold bug. Yeah, I don't know. So the thing is that my kids had all kind of been sick and I had been fine. And then there was one day where I didn't get very much sleep because the baby was screaming all night. And like the very next day I got sick. So I feel like I got sick because I didn't sleep enough. But I've been sleeping really well the last few days and I don't know. I was also more like, does it feel justified? Because I justify it to myself as I only vape during training and I follow. Well, yeah, but it's not good for you. And it's, you know, like you said, nicotine is this double-edged sword because it does reduce your stress during trading, but then when the stress is gone, when the nicotine is gone, the stress is like 10 times worse. And so you get these people that are really high strung, just like the guy in The Big Short. He was just like totally stressed out that whole movie, right? So high strung. You don't want to be that guy. That doesn't necessarily help your trading. But so what's better is you're completely clean because that's better for your health. And you have natural ways of dealing with the stress so that you perform well in stressful situations. That's just better for you, right? So to quit, you have to, it's always cold turkey. I've never seen somebody that like they kind of slowly wean themselves off of it and then no. It's always got to be cold turkey. Cold turkey, just bear through it. And you have to have a different habit that you're replacing it with. A lot of people, they'll start working out or something like that, right? But if it's for your trading, you might need something like a stress ball or, you know, something to kind of hold and mess around with while you're doing the trading. And doing things like chatting with us on stream is something that I think can kind of help. This is where it gets all very interesting that like, again, because we have to utilize these neural networks in our frontal cortex to be effective at trading, right? Okay, if that's like our biggest weapon, our biggest advantage, then we need to keep that working as well as possible. And it's just wild to me how big of a difference all of these things can make. Like what you're eating, how often you work out, how much sleep you get. So I got good sleep last night. Something that was kind of off because I did wake up in the middle of a dream. So I was a little groggy waking up, but that's okay. Get over that. Drink water. I'm fine. But I did get plenty of rest last night, I think. And it worked out yesterday, so I feel... And you notice that today I'm not pausing as much. Like I'm much more on the ball today than I was like 2 days ago. Probably largely because of the working out. It can make a huge difference, especially to the type of person that tends to want to trade. You cuddle after trading. That's what I need. Not that my wife doesn't like to cuddle me or anything, but it's right now in our house, it's like things are a little bit too wild for my wife to just come and snuggle me because I feel traumatized by the market or something, you know? If it was a really traumatizing day in the market, I go and I find the weighted blanket. So Monster Ultra Zero. Oh, man, I hate caffeine too, but caffeine has an effect on me that's different from most people, so I don't. But like my wife, she drinks the Red Bull, man. I don't think that's good for you to drink it as much as she does. I drink water. I drink water and eat chicken. As she's been, you know, my wife has been cooking a lot more, and she's starting to get good. Because for a while there, I was like, every meal, every dinner, it's dry chicken. It's dry chicken and rice, and I'm sick of that. But the chicken hasn't been dry this week. It's been good this week. I feel these are some complaints that come from a place of privilege. Well, yeah, that's true. Which is to say that, like, so many retail traders think that you just need to master, like, this is the Mark Douglas way of doing things. That's why this is like, I hate to criticize Mark Douglas because his book is really, really good, but he's ultimately wrong. He's kind of like libertarians. Like libertarians, almost everything that they say about the markets are correct, but their larger theory about the world, which is that if you just let the markets completely do their thing and you get out of the way, everything will be great, is just so dead false, right? And Mark Douglas is the same. His idea that all you got to do is just sort out your psychology and you'll find a way, you'll become success. It's total bullshit. It's total bullshit. And the reality is that if you do not have an edge, there is no point in you even talking about the psychology, man. You need an edge first. You need to understand why the market moves the way that it does. And if you're, and by the way, you know, if you're new to the stream, if your edge is some chart pattern, it probably isn't actually an edge, right? But I digress. Once you have an edge, or at least you have a model that you know is backed, like let's say it was taught to you by Goldman Sachs, or you have all this empirical evidence backing it up like we have with this stream. Okay, now all of the sudden, the mental aspect of it is almost everything, right? How do I stay focused when I'm streaming? How do I ensure that I'm getting all of the important information and properly incorporating it into my trading? And, you know, how do I deal with this whole thing that, like, when you take a trade, it's a reward, and that actually makes your brain work better. And when you take a loss, it hurts your performance. Like, you'll start to think not as well. How do you deal with that? Yeah. Well, one of the things is talking to you guys here on stream helps with that a lot. Right? If I take a bad trade and then I can turn around and talk to you guys a little bit, and that gets the chemicals going again, and then I can come back and trade again. Let's see here, Tiger. I'm not a huge fan of everybody. Think we're talking about Mark Douglas. He's got some good content, but I'll admit I'm just not a fan. Yeah. Yeah, like you can't guess and predict the things that traders will do this full-time have to counter adapt to. Everyone is just like, which strategy works? Trading community is weird and misguided. Well, yeah, because, well, I mean, it's an unfortunate thing is that when we were all young, we were kind of implanted with this idea about what the markets were, right? Because in the 80s, that sort of thing maybe made sense. It's just that it disappeared very quickly with the computers, right? Do you feel any connecting to risk anymore? Personally, over time, I just feel totally detached and think of normal money numbers on a screen. I think that when I'm taking my usual size, that yeah, I don't think of it a whole lot. If I take a $10 loss, I don't care, and if I catch a $10 or $20 win, I'm slightly happy. When I catch the $50 ones, then I'm like super great, right? But ultimately, it used to be that I would take a loss. Like if I had a limit down day, it would just ruin my whole weekend. But now I sleep on it and I'm usually fine the next day. But if I'm coming in and I'm trading, if today I decided to trade 2 contracts, I don't think I'd be doing that until January, but if I was trading 2 contracts a day, it would probably make me nervous. Yeah. Probably make me really nervous. Please tell me about your medication. I don't know if on YouTube we're really allowed to talk about those sorts of things. I guess I can, yeah, I don't know if I should really talk about that, to be honest with you. Yeah, I do. I trade like micro treasure yield futures. I love it. Because that was the thing, was that like I found that when I was trading ES, for instance, that it was just too much, you know? Like once I got my size down, I did so much better. I just moving over to this instrument, because I tried for treasuries. The whole thing was like I was in treasuries for a long time and I felt like I was kind of getting it, but kind of was struggling. Then it went over to ES and didn't really have success with ES, but it was when I was trading ES that I started to come in, you know, really learn and build that model that really incorporates the flows. Then I came back to the treasuries, and it was a combination of, okay, now I have a model that works. I understand treasuries so much so I can actually predict what those flows are going to be, and the size is so small that I can actually function. And then all of a sudden I was pulling out the kind of performance that I wanted. So, of course, we should size up, right? But I don't really care too much about it, so I don't worry too much. But we do need to size up at some point. So I said, maybe, you know, like the first 3 months of the year are usually the best for us in the treasuries, and maybe then I might, depending on the liquidity and everything else that's going on, maybe we'll size up then. So yes, most of my trades are in the micro 10-year. Sometimes, like today, I took a trade that was a sim trade. Today, I didn't feel very confident, and I wanted to test kind of a theoretical trade that would theoretically work in this range-bound market. I'd say it worked pretty well, but I took it on sim with multiple contracts in the treasuries, right? So that's what I'll do, is like when I don't feel confident, but I just kind of want to get in and start to get a feel for the flow of the market, I'll take a sim trade. Or if the thing that I want to try really requires multiple contracts over a range, then I'll do it on sim, because I don't really want to do that on micros right now. I don't know if that sort of strategy would work with micros with the commissions and everything, but I wanted to size up to 25 to 30 kind. Well, this is where I go back to again, like new orders have a strong impact on the market, and you know, you'd be surprised how much of an impact a 30 lot can have. I would be really, so from what you were saying, I'm kind of assuming that you're taking a range bound trade that wins most of the time, right? Trading a 30 lot could cause problems with that. Like, because the kind of action where you'd want to trade range bound is going to be like a quieter market where not as a whole lot is going on, right? And that's where a 30 lot would have a measurable impact and could screw up the trade. No, I don't. So I don't want people to follow my trades. So I'm kind of sneaky about it. Does that hurt? Does that hurt the stream? Does that turn people off away from the stream? Does that, you know, maybe people would be more engaged if they knew that I was taking a trade and they were trying to shadow it with me? I don't know, but I'm super paranoid about people trying to front run and or mess with my trades. So I will kind of, you might, if you're watching the screen, you might see it when I do it, when I was like, I'll see something and that's in line with my theories, and I go, and come in and take the trade, and I'll be really quiet about it. And then like 5 minutes later, everybody realizes, oh, he took a trade. Right. So I don't post them anywhere, but they're here. They're all recorded here on the stream. Fortunately, I might take 1 or 2 trades a day these days now, so go and find them. I like it how it is myself. Okay, cool. But that's also why, after the trade, I spend a lot of time talking about, okay, what were the important factors in getting in there? Because I'm trying to give you the information that I had in my neural network that I want you guys to have too for the future. Because the way that I look at it, the way that I look at the stream is not, I'm some guru and I am just condescending from above to share my knowledge with you so that you don't have to go through all of the difficult things that I did in the past, sort of a thing. I mean, I do want you to be successful and not have to go through that pain, but that's not why I'm doing it. There is a selfish interest in it for me. What is that? Well, this is a difficult game, and it's hard to do it all by yourself, right? It's hard to find all of the relevant information by yourself. So having a small group of people is really, really beneficial, right? So what I want is I want to get everybody else on the team to get their models up to snuff to the point where they can start to contribute as well, right? And then that's where you get people. I think Octavius is probably one of the best examples. He's been really, really good lately. They will come in and will say, okay, well, I know about this, this, and this that it sounds like you didn't, that you aren't factoring in. Okay, right now we can incorporate all those things, and we're all trading separately, but we're helping each other, right? And I would not have been able to develop the success that I have had. Not that I've been super successful or anything, but I've done pretty okay here with the micro treasuries. I wouldn't have done any of that without the help from the stream, right? So my intention is to help get people up to a certain level where they can contribute back. That's the objective, and that's why after the trade I talk about here's what I knew, etc. Well, posting your last trade, well, so we can always go back and look at my trading over the last however much you want to look at. So here was the one that we did today. So the one that we did today, I got an average price of 0.4 and I took it off at 0.8. And I used, I took 10 contracts through it, but I never had more than 3 contracts on. So I put on 3, and then there was 2 other contracts where I just had scalped a tick to kind of bring my cost basis lower, right? I took it at 0.4 and then I took it off at 0.8, and you can see the times that I opened and closed it, right? Opened at 9:11 Eastern time and closed it at 9:30 Eastern time. Oh, I actually was in that for a good 20 minutes. Yeah. Well, we can even go further back than that, I think. I don't know if my trading, if we look at the trading over the last 2 weeks, it will be stellar, but we're really only taking 2 sim trades within that time period, huh? I did have a losing streak there, though, with the treasuries. It's an overall net profitable, right? Because my 2 winners were almost $30 and $20. I had some losers in there. You can go back. The whole thing is that October wasn't. Was it October or was it August? Wasn't very good for me. That's where I made the cup. I had like 3 $50 losers or something like that. So that was kind of like I had profits, and then it brought me back to break even again. Now we're digging back out of the hole again. Oh, are you familiar with the cut and reverse? Yeah. Um, like the whole thing was that part of the way that I did the trading was like, okay, I was doing completely technical analysis, like chart patterns. Like I would just look for head and shoulders and that sort of stuff and make decisions based on that in stocks. And then I got into futures and I learned about the DOM and the order flow, and I wanted to learn the DOM just because I thought it was so cool, right? And when I was at the firm, like I talked to traders and they're like, oh yeah, like if you want to trade professionally, that's what we use. That's a really important tool. So I went and I learned the DOM, like the no BS day trading way, right? And I would do things like the cut and reverse drill and just trying to catch a tick. And here in the treasuries, just trying to catch a tick is a lot more useful of a exercise. But I did it. You go way, way, way back into the stream, you'll see days where we spent just the whole day doing that, right? And kind of what I would find is like, I want to take this setup or whatever, and it would work really well for a while, and then it would work absolutely dismally for a while, and I'm like, what the heck, right? I kind of, well, and this is where I was like, it seems like the technical, I'm looking for a pattern, and I would need way, way, way more data to justify trading off of that pattern than I have, right? And it wasn't having success with it. So I basically gave up on all of those things, because during COVID, I started to go into things like, well, okay, I could have told you that the number of new infections would have been less on this day than on this day, because most people don't go into the doctor to get it checked when it's a Friday, Saturday. They go back in on Monday. And we were getting trades off of that. And then I started to read the books and stuff, and I realized, oh, okay, that's why none of these things work. This is why I need to focus on informational efficiency. That's why what I was having the most success with, right? And so I think that what you would typically be taught about order flow is basically information that would have been really great and probably brought you profitability if it was the year 2000. But, there's not an edge in it now. So, cut and reverse is great, but like, I'm super suspicious of this. Like, okay, you're just doing the cut and reverse drill and you're making money from that is okay. But you're probably trading ES, right? ES is just like super random. It's very random. So but I'm very intentional about, I'm only going to incorporate things into my trading that I can really prove, right? Like if it's technical, I really need to be able to prove it. There is something to, if you watch the DOM long enough, you start to get this intuition. But I don't think that intuition is enough on its own. The high at 912. Well, sorry. So the trade that I took, I did on a sim account on ZN, not the 10-year micro. If I had taken it in the 10-year micro, I think it would have been something like 4295 to 428 maybe. Would have been like 15 ticks in the micro. But you see this, if I just see it was on ZN. See, the thing that I'm looking forward to hear from you, though, is like, something that tells me that what you're doing is not just taking on risk, right? Because to me, if I come in and I say the S&P 500 is in a range, so I'm going to take a profit that's well within that range and have a stop that's well outside of that range, that's just taking on risk. That's not actually edging that. Where I need to see is like this, over 100,000 samples, there's this behavior. And I take advantage of it this way. Before I would be like, okay, let's do that. Fed's barking. I am open to an inflation target range after we hit the 2% goal. Joseph Wang commenting on that. Shifting to a target range is how the inflation target will be moved higher. Long bond below 5% is crazy, in my opinion. That's very interesting. So he's saying that the 30-year should be above 5% because he thinks that we're not going to get back to 2% inflation, basically. Well, given what the market thinks is going to happen with the economy, he's probably right. Well, you know what? Remember when I said, okay, if it comes back to 05, that's where I would have to think about again, will it bounce here? Or was what Barkin said big enough that it could just sell all day? And I'm kind of not sure because I think that what he said was significant, but we're still in kind of like a contracting volatility thing. So I'm not going to take the trade that I was going in on or that I had hypothesized. Look, it did work, actually. They went back from 05 to 08 again. Fell over a while once I got some kind of weird Dom sense that correlated with pulling and stacking and how the price would move in different scenarios and higher time frame context. So what I've kind of found is that there's kind of like if you're getting a trend that's moving up, right? And then it kind of folds back in on itself. And I don't know how I can tell, but there's kind of a way that you can tell that it's folding back in on itself, right? And so you can kind of catch these, but to catch every single one of them, it's kind of hard. That's why I would just rather, like what here in the treasuries, I would just rather go long here, wait until the square root law starts to take effect, and get out. Be done. That's how I do it. If it's in a range or something like that, how do I know that they're not going to shoot it out of the range and then back in? And can't. It's random. And the market makers are like doing stuff specifically to screw us up. So I just don't play that game. Although I am kind of, because what am I doing? What was I trying to do here today? If I come back over here. Because what I was trying to do was use my inventory cost basis to catch this, right? So basically what I did was I got long about right here and then held through this drawdown and then took profits right here. So you see these cost basis lines? So my general theory is if we're going to be in a range bound market, then I can take it across this over and over again. Essentially. Oh, did I actually? You know what? I don't think I took it over here. I can't see the time. Where's the cursor? Hate it when it does that. I took it at 7:15, right? 7:10. Okay. So I got in here. I got in here and I got out here. And now I'm saying when it got back to here, I could have done that one, right? Just anticipating them going back and forth across the market maker's cost bases. So that is a range bound sort of a trade. And I guess in this particular market regime, works. I've noticed for around 2 years after certain ticks that don't hold, the market just pulls the orders and price moves higher than it should, and I scalp those. Oh, so you're trading breakouts. Trading breakouts. This is different. So like a really good way to measure your performance, I think, is like, what is your win rate? Oh my gosh. Win rate, and then what is your average loss versus your average winner? Right? So if your average loss to your average winner, so basically I say, how big was my win over how big was my loss, right? So if my winners are 2 times my losers, then I have an R factor of 2. That's what people talk about, right? It's like my winners are 2 times my losers, right? But if your winners, average winner, are less than your losers, then you have 1 less than 1. We call it R factor. R factor less than 1. Okay. So if you have an R factor of less than 1 and a win rate and or a win rate, we call that P, probability, greater than 0.5, very good chance that your profits are just from taking on risk. Okay. But if you have something that's like R equals 1, so I want my winners and losers to be generally equal to each other. So R equals 1 and my probability is greater than 0.5. That's great. There's really good chance that you have something that actually is working over lots of samples. If R is like greater than 2, right, you're going to have a probability that's going to be more like greater than 0.2 or something like that. These are strategies. These are actually can be really, really great strategies, but they're kind of harder to trade. They're kind of harder to trade. Most people won't stick with them. So a breakout strategy might be like this. If it breaks out, you're making like 2 times your money. And if it goes back into the range, you stop out. And so you're getting like 2 to 1 risk reward. Right. So if you're trading like that, then that's freaking awesome. But I'm guessing, based on what you've told me so far, without you giving me the stats, that you're actually more like this. That your average loser is actually maybe bigger than your average winner. Yeah, let's see. I'm in the unconventional range of 82 to 88%. Right, so you probably are in this category. Like, there's no way that you get 80% without having an R factor less than 1. It's odd that you would trade breakouts with that, but okay. I don't like people giving my win rate because people think I'm lying or it's lucky. No, it's not that you're lying or it's lucky. I'm concerned that your win rate does not actually mean what you think it means, right? Basically what I'm saying is you're probably making money from taking on risk and the strategy is not actually long-term profitable. That it won't survive the fat tail. But this is the whole thing that we're talking about is like, I would tell you that we're having a pretty good conversation here today, but I don't think that you're going to believe me. I don't think that you're going to go back and say, oh, you know what? I probably better be careful because in a year I might blow my account. That's what usually happens. Oh my gosh, it's 9:09. I'm past my time. I should end the stream. Yeah, like really the way that it is R factor of less than 1 is a red flag. These strategies can work, but you have to be taking a lot of trades and you have to have a lot of capital. These strategies are better suited for a quant firm. Yeah, always keep an 8-point hard stop. But you're probably doing like 8-point stop, 4-point profit, right? That's like the Pat's price action trading way of doing things. Sent you something. I think it sells your. Oh, I'll take a look at that. Oh, 8 tick. Yeah, the 8 tick is. That's even worse, actually. 8 tick stop and 4 tick profit. How do you hold a 4 tick stop in the S&P 500 these days? I'll never know, but you know, if you're catching yeah. So this is the thing: is if you were really truly holding to that over like 10,000 trades, then I would be like super impressed. But because what's going to happen is the volatility of the S&P 500 is more than 8, so it's kind of hard to get that really good win rate just from random chance, right? Anyways, I gotta get going. I will see you guys tomorrow. In the meantime, stay excellent, team.